An empire never falls from the outside in, it falls from the inside out. Today we see what happens when a small handful of people who are capable of causing havoc will do. More and more economic weakness will come, and it's all manufactured. The system of control is defined and required. They print as much as they want, shuffle around zeros and ones, and you must ultimately pay the price. You came here for the truth, so let me unveil that for you. We are talking about a system designed to control you. They are shuffling these numbers around on their screens, printing up the zeros and ones, and making this happen. And all you are trying to do is work your 9-to-5 job. You're trying to operate your business. You're trying to save for yourself, for your family, and trying to put food on the table. And these individuals can dictate the value of that currency that you are forced to use, because that's how you get paid. And this just shows you what they are capable of, and it really just irks me in a way, because there is no competition that they're trying to allow anyway. They're trying to make you and force you to basically apply all that which you have into this one system, put all your cash in, put all your savings in, and then they are the ones that are going to manipulate it and potentially bring the value down as close to zero as possible. They have one clear agenda, and that is to devalue the currency that you use. So on this channel here, in my books, and what I talk about regularly is that we need to have real assets. That's what it comes down to. And there are many real assets. There are lots of different things, but essentially what we need is something that holds value while they're manipulating this. And if that ever changed, if they weren't manipulating it somehow, then maybe we can look at this a different way, but that isn't the case now and hasn't been for a very long time. So this is what we're dealing with. Now I'm going to show you what's happening with China and what that really leads into, as well as the United States, because I've got some data on that as well. The debt has been picking up, and of course the battle has too. Let's get into it right away. China and 14 other countries agreed to set up the world's largest trading bloc. Accord will lower tariffs on trade between member countries even further. So this is all about what you're seeing right here, ASEAN, and this group is, the 10 countries, but they also signed on some additional countries, which includes China. I'll show you that in just a second. But I just note this because in addition to what we are looking at with the AIIB, and there's been other ones that I've seen previously where China sets up a group or China sets up something else, and they are trying to facilitate trade in between the countries, and they are really becoming friends and allies and business partners. And this is of course really good, because if you look into the future for these countries 10 years, 20 years, 30 years down the road, this is where all the growth is coming from. A lot of these countries in Asia, their growth is picking up. They're starting to really get away from where they were, let's say, a few decades ago, and certainly China is one of those countries. Right here is where they mention the fact that you've got the 10-member Association of Southeast Asian Nations, but they have also signed on China, Japan, South Korea, and I wanted to mention this, Australia and New Zealand, because even though there's been a little bit of back and forth with Australia and China right now, it looks like they're willing to do business in this area, and certainly that this has been their great trading partner for a while, so they want to continue that. And I'm not sure what's going to happen with all those tariffs, but we will see. I know that they do a lot of trade, so this would not be good for business if more tariffs start to pile on, that's for sure. Now, I don't know what's going to happen 5 years from now, 10 years from now, 20 years from now, but I can certainly look at all the data, and we see that the growth is definitely coming from a lot of these countries here, and we know that they have their own issues to deal with. But all I'm trying to do is look at the data and the information wherever you are around the world. It's important, of course, to share what you have to say and what you see around you, because you can only pull so much from the data. And I always really encourage people in the comment section to do their best to try and share what they see. China's $900 billion funding gap to provide clues on stimulus. Demand for cash to rise as policy loans and interbank debt mature. Sovereign yield to keep climbing as PBOC is hawkish. So we've got some information here and people are just looking at it, wondering what we are going to see out of the central bank in China. Here, expiring loans. Banks face mounting MLF maturities in November and December, and it looks like about 600 billion right here, as you can see, for November and December. I don't know how much of an impact this will be. We don't really have a good insight as to what goes on underneath the hood in this country, that's for sure. So it's no telling what we will have come out of it, but certainly we've seen a lot of the stresses on this particular country in the financial sector. There have been companies that have been failing, and the actual government had to take over these banks, and certainly it's not going to end here. We're going to see more of that continue on, not just in China, but other places around the world. Now, they do get into the details if you want to read it, but I'm just showing you that there are problems in the financial system no matter where you look. Take a look at this one here. I just mentioned the fact that some of the financial sector was having problems in China. And we also have this, the abrupt 1 billion yuan or the $151 million bond default of a state-owned coal mining company in central China set off reverberations across China, affecting its parent company, industry peers, and other state-owned bond issues, and triggered an investigation by the interbank bond market regulator. So we'll see what happens, because I really think that it's much worse than we're being told. I don't want to speculate necessarily exactly what's going on, but I just bring you the data. You do what you want with it. And that brings me to this. We're looking at the United States, and specifically the four banks, JP Morgan, Wells Fargo, Citi, and Bank of America. You remember this, probably shown it more than once. Big Four loan loss provisions. They were getting ready for something big to happen. They were immediately, you could see the spike up here, getting ready for some serious pain. There's going to be some seriously bad things happening, and we'll be ready. We're going to put some cash aside in case that happens, and then we'll deal with it. Well, clearly they don't really see that as happening, because we're now back at that level from 2019 and before that. So I think this is, of course, a big mistake, and maybe they're just thinking that they'll get another bailout, so why bother? Percentage reporting tighter lending standards for commercial and industrial loans for large and medium firms. I also noted the fact that while we had come up just like we saw previously, now it seems to be more relaxed. Hey, why not, right? Everything is totally fine. Morgan Stanley says go risk on and trust the recovery in 2021. I think this is hilarious. I wanted to bring it to you. Strategists recommend overweighting equities and credit as if that wasn't happening already. People are so over leveraged. They're so overweight, and it is just unbelievable to suggest that even further. Report suggests selling the US dollar sees volatility falling. We'll see what happens. I'm sure the VIX index could go down, but certainly volatility is, there's an abundance of it. They just keep shorting that position, but we're not supposed to talk about that. Morgan Stanley strategist said an expected V-shaped economic recovery was coming here, and that would be a favorable environment for stocks and credit next year. That's right, the V-shaped recovery. You know how a V looks, that's a V, but instead, if your recovery is kind of like this, I guess if you just tilt your head, you can kind of see a V. That's the way that they present this to you. And it's mind-boggling. Here's the quote: "The global recovery is sustainable, synchronous, and supported by policy following much of the normal post-recession playbook. Keep the faith, trust the recovery." It's like, a sales pitch right here. It's unbelievable. Anyway, this is looking at the end of 2019 into 2020, and specifically you're seeing the MSCI All Country World Index. So this gives us a good idea of what's happening all around the world, and believe it or not, the RSI on the whole world scale, you look at this, we are moving into overbought territory, and that just shows you how bullish the investors have been, even though there should be caution. Doesn't mean that you don't invest. You hedge your bets. You invest where you think it's safe. You start to spread out your risk. But no, that doesn't happen. And that is always a dangerous policy. I've shown similar charts to this from Real Investment Advice, so I've got a few. I want to move through them really quickly. Despite zero rates and QE, the economy never achieved real growth. I completely agree with that. The red line here, we're looking at the Fed's balance sheet, and you could see how it accelerated like crazy. But over the years, it's been going up and up with QE1 and QE2 and so on. And then you look at what's happening with the Fed funds rate. They brought that up to 2.5% approximately, brought that down to zero. And what has happened here? Well, the S&P 500 has performed incredibly well. We have watched the stock market go higher and higher, but growth hasn't been there. There is no growth along this period of time that is anywhere near what we see with the amount of debt, the money printing, and of course the ridiculously low interest rates that are dangerous because you can never increase them without creating a major crisis. And that just shows you that they are willing to do anything in order to devalue their currency. I will say it again, the intention is to devalue the currency. This just shows you some comparisons. On the top left corner, you're seeing the S&P 500 versus the GDP growth. Clearly, one is much, much higher than the other, and you can guess which is which. On the top right corner, you're looking at growth of stocks versus real GDP. You're seeing something that cannot be mistaken, and yet this is what they do. Bottom right corner, you're seeing that with the Fed as well. Similar actions are going on, and it should not be really looked at separately, because the increase in the balance sheet of the Federal Reserve, of course, has a dramatic effect on what we see with the stock market and has nothing to do with the actual economy. And then we have this total system leverage, government, corporate, household, margin, banks, student loans. This has gone aggressively higher throughout this period of time. And you just look at the real GDP growth 5-year average, and it just goes down and down and down. And even though during this period, as I just showed you, interest rates declining, more money printing, easy money policies, it doesn't matter. The velocity of money, I needed to update you on this as well. You can see that this had been declining. I mean, it's been declining for years and years, but recently, just 2020, it basically fell off a cliff. And now, if you look at it, just slightly coming up. So I'm going to keep you up to date on this. I want to know if that is a trend, if it is climbing, where is this all happening? Where is the money going? We need to see how there is an actual recovery taking place, or is this just a bump in the road and something that we will see kind of be wiped out in no time at all? And you can see where the trend is. So certainly, unless something has changed dramatically, this is something that we should definitely keep our eyes on. The Treasury supply is now much greater than the Fed purchases. Coming out of Bank of America on the left-hand side, net Treasury supply in the billions of dollars. Look at this. The third quarter of 2020, you've got 500 billion. On the right-hand side, Fed Treasury purchases is 233 billion. So essentially, what we could expect, maybe, just maybe, that the Federal Reserve literally doubles the amount that they are printing in order to actually monetize all of the debt. Can they do it? We'll see. That's all for this video. If you found it informative, please give me a thumbs up. When you do so, you are helping me out. Thank you very much. Learning e-commerce is an important skill. Maybe not even for yourself, maybe for your kids, maybe for your neighbors, maybe for your family. Well, people are just unsure of where to start. Why not check out my free e-course, theamazongps.com. The financial system is complex, it's convoluted, there's so much to it, and yet people don't know where to begin. And if they're already in on it, they don't know how to actually ask the right questions. Well, these two books get into all the details you need. You could take a look and actually flip through the pages for yourself at the link in the description. And if you want the audiobook instead, you can get that at themoneygps.com. Hold on a second, don't go anywhere. You were about to click off, weren't you? Well, you definitely want to check out this video if you haven't already. Click it, I'll see you there.